Hey everyone, Joe here from Avalon Accounting. Today we're looking at the big Canadian tax changes for 2025, including the GST holiday rules that were just announced. We'll break down the updates on RRSP and TFSA contribution limits, new CPP changes, and some possible adjustments to capital gains tax that could affect Canadian investors and business owners. So let's jump right in. Starting with one of the biggest tools for Canadian retirement savings, the RRSP. For 2025, the maximum RRSP contribution limit has gone up to $32,490. That's an increase of $930 over the last year, which lets higher income earners save even more in a tax-advantaged way. Higher contribution limits like this allow you to shelter more income, growing your savings faster for retirement. So if you're in a higher tax bracket, making the most of your RSP limit is a powerful way to secure future income while saving taxes today. Another essential savings tool for Canadians is the tax-free savings account, or TFSA. For 2025, the TFSA contribution limit is $7,000, the same as for 2024. For context, it was $6,500 in 2023 and $6,000 back in 2022. So if you were 18 years or older when the TFSA was introduced in 2009, this means your maximum lifetime contribution room will now be $102,000. Because TFSAs allow all growth within the account to be tax-free, this is a fantastic tool for short and long-term financial goals. A relatively new option to consider for homebuyers is the First Home Savings Account, or FHSA. This tool was launched in 2024 to help Canadians save on their first home. The FHSA combines features of both RRSPs and TFSAs, allowing contributions to be tax-deductible while also letting investment growth and withdrawals remain tax-free if used for a home purchase. The FHSA rules for 2025 are unchanged, with an annual contribution limit of $8,000 and a lifetime cap of $40,000. So if you're a first-time home buyer, or if you haven't owned a home in the last 5 years, this account could be a great addition to your savings strategy. All right, let's move on to the Canada Pension Plan, or CPP, which helps ensure income for Canadians in retirement. The standard CPP contribution rate for 2025 remains at 5.95% for both employees and employers, but the yearly maximum pensionable earnings, or YMPE, has increased to $71,300. For employees and employers, the new maximum contribution is $4,034, which is up from $3,754 in 2024. If you're self-employed, you pay both portions, so your maximum contribution limit will be $8,068, an increase from $7,508 in 2024. Now, CPP 2.0 is a second layer of CPP contributions designed to increase future retirement benefits. In 2025, contributions for CPP 2.0 apply to income between $71,300 and $81,200, an amount called the Yearly Additional Maximum Pensionable Earnings, or YAMPE. For 2025, employees and employers will contribute an additional 4% on earnings within this range, with a maximum CPP 2.0 contribution of $396 per person. Self-employed individuals who cover both contributions will see a maximum CPP 2.0 cost of $792. Adding both the regular CPP and CPP 2.0 contributions, the maximum total for employees will be $4,430 in 2025, up from $4,055 in 2024. Employers also match this increase, which will impact payroll costs. For self-employed individuals, the total CPP contribution in 2025 is $8,860, up from $8,111 last year. These increases reflect ongoing efforts to enhance retirement income for Canadians, though they do mean higher contributions for the year. Now, let's look at the 2025 federal tax brackets, which determine how much tax you pay as your income rises. The tax rates themselves haven't changed, but the income thresholds have increased slightly to account for inflation. For instance, the lowest tax bracket, taxed at 15%, now applies to income up to $57,375 compared to $55,867 in 2024. Each bracket has similar adjustments, which should allow you to keep a bit more of your income before moving into higher tax brackets. These annual shifts help ease the effect of inflation on Canadians' overall tax burden and let you retain a bit more of your income. Another beneficial change for 2025 is the increase in the basic personal amount, or BPA. This is the amount of income all Canadians can earn before paying federal income tax, and it's risen to $16,129 for 2025, which is up from $15,705 in 2024. This increase provides a bit more tax relief, especially for lower income earners, as a large portion of income remains untaxed. The BPA adjustment helps offset inflation and keeps more of your hard-earned money in your pocket. Now, let's go over some proposed changes to Canada's capital gains tax. Here's what's likely coming. First, the lifetime capital gains exemption, or LCGE, may increase to $1.25 million from $1,016,836 for selling small business shares. The inclusion rate is also likely to rise from 50% to 66.7% on capital gains over $250,000 for individuals, meaning a higher portion of your capital gains would be taxable. For corporations, the 66.7% rate inclusion would apply to all gains, i.e., there's no $250,000 threshold. Finally, the Canadian Entrepreneurs Incentive is a proposed benefit for business owners in specific industries like agriculture and manufacturing. This incentive would allow a reduced inclusion rate of 33.3% on up to $200,000 of capital gains annually, helping qualified small business owners keep more of the sale of their businesses. Now, the idea is that this would increase yearly until reaching $2 million by 2034, but note that certain fields like real estate and finance may not qualify. There is a list of excluded businesses on the CRA's website, and I looked, accounting businesses are excluded. If these proposed changes go through, they could also have a mixed impact on individual and corporate business owners. For example, the higher LCGE would allow individual business owners to sell a larger portion of their business without any capital gains tax. The CEI, if available to your business, could provide a lower inclusion rate on some gains, making it an appealing option for certain sectors. The federal government has announced temporary measures to help ease financial pressures on Canadian households. Here's what you need to know. From December 14, 2024 to February 15, 2025, Canadians won't have to pay the 5% GST on a variety of products, and these include Christmas trees, children's clothing and toys, beer, wine, and restaurant meals. For provinces with harmonized sales tax, or HST, like Ontario, the federal portion will be removed. In provinces with separate federal and provincial taxes, only the GST will be waived. These initiatives are aimed at helping Canadians through tough economic times. While direct financial aid was previously avoided due to inflationary concerns, it was noted that the cooling inflation rate now makes such measures feasible. However, these changes have sparked a lot of debate. Some critics argue that the temporary tax break are political moves rather than long-term solutions. Others point out potential logistical challenges for businesses, especially implementing the GST exemption. For households, this temporary GST and HST relief could reduce costs on key purchases during the holiday season and early 2025. Businesses will need to adjust their systems to handle GST-free transactions during the 2-month window, which will create operational hurdles. This is more of a mid-2024 update, but still relevant here. The 2024 budget brought significant changes to the home buyers plan, making it even more beneficial for first-time homebuyers. The HBP allows first-time homebuyers to withdraw funds from their RRSPs to help purchase a home tax-free as long as the funds are repaid over time. Recent updates to the plan make it a bit more helpful for navigating today's real estate market. And here's what's new. As of April 16, 2024, the maximum amount individuals can withdraw from their RRSP under the HBP has increased from $35,000 to $60,000. So for couples, this means that each partner can withdraw $60,000 from their respective RRSPs, allowing for a combined total of $120,000 to be used toward a down payment. This update reflects the growing cost of real estate and helps first-time homebuyers meet the larger down payment requirements in today's market. The government has also extended the repayment grace period for withdrawals made under the HBP. Previously, you had to begin repaying the borrowed funds by the second year after withdrawal. Now there's a 5-year grace period for withdrawals made between January 1st, 2022 and December 31st, 2025. This means buyers have more time to save before starting to repay their RRSP, offering greater financial flexibility in those critical early years of home ownership. Now, if you're planning to purchase your first home, the updated home buyers plan offers an interest-free option to help you afford the down payment. The higher withdrawal limit and extended grace period make this a more attractive tool for navigating Canada's challenging real estate market. Navigating tax changes like these can be tricky, but at Avalon Accounting, we stay on top of all these updates to keep you informed. If you operate an incorporated business and have questions about the new 2025 tax rules or need help with business planning, reach out to our team for support at avalon.cpa. We're here to help you make the most of these tax updates. All right, that wraps it up for our overview of Canadian tax changes for 2025. Thank you so much for watching. If this video helped clarify things, be sure to give it a thumbs up and subscribe for more insights. We'll see you in the next video. Cheers.